So there's been a great deal of recent public conversation about Federal Reserve accountability with respect to monetary policy. And I view my talk today as being a natural outgrowth of that dialogue. American monetary policymakers like me are employees of the public. As I'll describe, we are charged by the public's representatives with achieving certain objectives. In keeping with this employer-employee relationship, my remarks today loosely mimic a standard performance evaluation of the kind that takes place in corporations all over America each year. I first provide an assessment of Federal Open Market Committee, FOMC, performance over the past 3 years relative to the committee's monetary policy goals. I then turn to what I see as appropriate plans for the committee in 2015, given its goals. So look back over the past 3 years to see what performance looks like, and then look forward in terms of what we're planning for the next year. Now, my remarks will differ in a key respect from many or possibly most other discussions about the FOMC. It is common to focus on what actions the committee has taken, such as our decision about asset purchases or interest rates. In my view, these discussions about what has been done are really tangential to monetary policy accountability. Accountability in any endeavor, including monetary policy, is not about what actions have been taken. Rather, it's about the results those actions achieve. Specifically, how well performance accords with the relevant objectives. Accordingly, my discussion of FOMC performance and plans will be relentlessly goal-oriented. Now, my goal-oriented approach to FOMC accountability differs from the approach taken in legislation about monetary policy accountability that is currently under consideration by Congress. The Federal Reserve Accountability and Transparency Act, or FRAT Act for short, would require the FOMC to tell Congress and the public how the committee plans to change the level of monetary accommodation in response to macroeconomic developments. A key element of the FRAT Act is a reference policy rule that would be intended to serve as a baseline for this communication. The rule frames accountability in terms of what choices the committee is making, as opposed to how the macroeconomy is performing relative to FOMC objectives. In my discussion, I'll explain how this approach to accountability means that the reference policy rule in the FRAT Act would be likely to degrade rather than enhance the FOMC's ability to achieve its objectives. Throughout my remarks today, please keep in mind that I'll be expressing my own views, and they're not necessarily those of others in the Federal Reserve System, and in particular, not necessarily those of my colleagues on the Federal Open Market Committee. So 8 times per year, the Federal Open Market Committee, the FOMC, meets to set the path of interest rates over the next 6 to 7 weeks. All 12 presidents of the various regional Federal Reserve banks, including me, and the 7 governors of the Federal Reserve Board, currently only 5, of course, contribute to these deliberations. The committee itself consists only of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents. I'm not one of those 4 presidents this year. At FOMC meetings, but I'm not one of those 4 presidents this year. So what do we do at FOMC meetings? For this group, this is going to be familiar turf. But at FOMC meetings, we decide on the level of monetary stimulus for the economy. At this moment, I won't get into details of what that term monetary stimulus means, except to make 2 high-level points. First, when the FOMC changes the level of stimulus, our actions tend to push inflation and employment in the same direction. For example, raising the level of stimulus will push upward on both inflation and employment. Lowering the level of stimulus puts downward pressure on both inflation and employment. Second, and this is important, the FOMC's actions affect inflation and employment with a lag, usually thought to be about 1.5 to 2 years, which of course means that as monetary policy makers, we have to be looking forward when we make our decisions about current policy choices. Key thing is, what is the FOMC seeking to achieve by varying the level of monetary stimulus? Congress has charged the FOMC with making monetary policy to promote price stability and to promote maximum employment. The FOMC has interpreted the first goal, price stability, to mean keeping inflation close to 2%. And so that's what the FOMC's job is to vary monetary stimulus at these various meetings in order to meet its mandated objectives of keeping inflation close to 2% and to promote maximum employment. So that's the context that I want you to keep in mind about what the goals of the committee are. And with that context, I now turn to a backward-looking assessment of the FOMC's performance over the past 3 years. And I'll begin by showing you data on performance with respect to the maximum employment mandate. And so the best known, I'm going to show you several kinds of metrics with respect to employment, but the best known measure of labor market performance is the unemployment rate. This is over the last 3 years. If you go back to December of 2011, at the very beginning of this chart, the unemployment rate is 8.5%. Since that date, we go forward to December 2014, the unemployment rate has fallen to 5.6%. I think it's fair to say that that fall was especially rapid in the past year, but I would add that the unemployment rate remains elevated compared to the FOMC's assessments of its long-run value, although it's certainly getting much closer. Now, the unemployment rate is the most widely known measure of labor market performance, but I think there are good reasons to view it as only one of many useful labor market metrics. The unemployment rate can go down for one of two reasons. It can go down because people find jobs, or it can go down because the number of people who say that who don't have a job, who say they have not looked that they have looked for work in the past 4 weeks, declines. So much of the decline in the unemployment over the past 3 years has occurred because the fraction of people who are looking for work has fallen. Okay, so how do I know that that's true? Well, I can look at the evolution of the fraction of people over the age of 16 who have a job, what's called the employment to population ratio. Now, in December of 2011, the employment to population ratio was 58.6%. It's risen, but it's only back to 59.2% as of December of 2014. Now, arithmetically, this means that the people who are getting jobs accounts for well under half of the fall in the unemployment rate over the past 3 years. So, you can do a calculation, which is an accounting exercise to figure out how much of this decline is attributable to the increase in the number of people who have jobs, and it's well under half. I think the good news here, if I look at this picture, is that the employment to population ratio has grown markedly in the past year. We can see that really, if you look back over the first 2012 and 2013, you really saw very little in the way of pronounced increases. I think the news over the past year has been much better on this dimension. I think this increase in the employment to population ratio is especially notable given underlying demographic trends. As the baby boom birth cohort, those born between 1946 and 1964 age, the fraction of retirees in the population grows steadily. So this demographic force in and of itself would be expected to lead to a decline in the employment population ratio over the past 3 years. Now, one way that we try to strip away, adjust for this demographic impulse, is to focus on the group of people who are in their prime working age years, which I'm going to, following tradition and somewhat arbitrarily, think about as the people who are aged 25 to 54. So we look at that fraction. Again, we've seen improvement in this fraction over the past 3 years. And again, I would say that that rate of improvement was especially marked in the last year. I think we've seen it, I think it's clear that we've seen an especially rapid increase in this ratio in the past year. Now, just because someone has a job does not mean that they're necessarily fully employed. In particular, the Bureau of Labor Statistics reports each month on the number of Americans who are working part-time, would like to work more hours, but are unable to obtain those additional hours. If you look at that fraction again has fallen over the past 3 years. But again, I think I would say that if you look at and that fall has been particularly marked again in the past year. You would have been hard-pressed to argue there had been much improvement over the preceding 2 years, but really in this past year, you definitely see improvement in this measure. So all told, all these charts I think tell a similar story. maybe with different magnitudes though, and I think it's important to keep in mind, that they document improvement in all of these measures of labor market performance over the past 3 years. And in all measures, the rate of improvement was especially rapid in the year 2014, last year. Okay, so then that brings us to the accountability question. Should Americans view the FOMC's performance with respect to the maximum employment mandate over the past 3 years as being satisfactory? Now, that's a hard question to answer on the basis of these pictures alone. Because clearly, employment growth, improvement, is better than non-improvement or falling backwards. So employment growth is clearly better than no growth, or worse, negative growth. But that still leaves us with a question. Should the FOMC have facilitated even faster employment growth by choosing making different choices about monetary accommodation? To answer this question, we need to turn to prices, because that's where the cost of monetary accommodation lies, is in the behavior of prices. So now I'm going to turn to the FOMC's performance relative to its price stability objective. As I noted earlier, the FOMC has translated this objective into keeping the rate of increase of the price level, the inflation rate, close to 2%. Even more specifically, we use the PCE inflation rate, so personal consumption expenditure inflation rate. And this is a broad measure of inflation that in particular captures the rate of increase of all goods and services, including those related to food and energy. Now here's a graph of how PCE inflation has behaved over the past 3 years. I think I would take away 3 main takeaways from this picture. First, PCE inflation has averaged less than 1.3% per year since December 2011. This is well under the target, the FOMC's 2% target. So that's the first takeaway. Second, relatedly, PCE inflation has been below 2% for a long time, over 2.5 years. It crosses 2% at around April of 2012 and has been below 2% ever since. Finally, in contrast to what we saw, by the way, in the employment pictures I showed you earlier, there's been little pickup in inflation over the past year. It went up and came back down, but really it's hard to say a sustained pattern of increase there. Now, to be clear, and this is important, the American public should certainly not expect the FOMC to hit its inflation target every month. But 2.5 years is a long time. The FOMC's performance in terms of price stability can be summarized pretty simply. The committee has not provided sufficient stimulus to hit its inflation target. Now, this persistent underrun of the inflation target creates a risk to the credibility of that target. For monetary policy to be effective, it's critical that investors and other members of the public believe that the FOMC is in fact aiming at 2% inflation and not at some higher level or some lower level. Persistent deviations from that target may weaken those beliefs. And my point is a very simple one, that you can say that you're aiming for 2%, but if you start to look at this kind of picture, you may start to have doubts about whether or not the committee is actually making choices to deliver 2%. Now, that's a theoretical point, but recently there have been signs of exactly this kind of reduction in FOMC credibility in financial market data. So here we plotted the behavior of 2 market-based measures of longer-term inflation expectations. So the red line is based on TIPS 5-year break-evens. These series are not based on surveys. They're imputed from the prices of particular financial assets. For the people in this room, of course, are very familiar with where this comes from. We use those prices to construct measures of inflation expectations 5 to 10 years hence. So in late 2014, really now early 2015, of course, we're late 2014, we're looking at the period 2019 to 2024. In 2015, we're rolling forward to 2020 to 2025. By looking this far ahead in time, we can strip away temporary short-run influences in the economy and focus on market participants' beliefs about the FOMC's future intentions. So to provide a little more detail here, the red line is from the gap between using the difference between Treasury inflation-protected securities and standard nominal treasuries. And then the blue line is coming off of zero-coupon inflation swaps from 10 years out and then 5 years out, and then in backing out what the implied rate of inflation is. Basic bottom line is that you see a pretty big decline here, especially over this latter part of 2014 and now into 2015. The FOMC so far has largely failed to take substantial policy action in response to these declines over the past 3 years that are especially marked in the past few months. And this lack of a response creates additional downside risk to the credibility of the 2% inflation target. So I close my discussion of price stability by circling back to the question I posed about the employment mandate. Should the FOMC have taken steps to stimulate more rapid employment growth? And the data on inflation suggests an answer to this question. Recall that monetary stimulus pushes employment and prices both in the same direction. By providing somewhat more stimulus, the FOMC could have stimulated at least somewhat more employment growth without creating undue inflation. That's what this picture shows, is there's room from the point of view of inflation to generate more employment growth without creating undue inflation. I'm sure this faster employment growth that monetary stimulus would have delivered would have been welcomed by the American public. So even though employment grew, it seems there was an improvement opportunity. The FOMC should have facilitated even faster employment growth. So my summary assessment of the past 3 years is that the FOMC underperformed with respect to the price stability mandate and the employment mandate. Now, I'm sometimes asked, what concrete actions could the committee have taken to provide additional stimulus? One concrete action would have been to not reduce stimulus. In mid-2013, the FOMC began communicating about the eventual elimination of its asset purchase program that took place from the end of 2013 through October 2014. These communications and the follow-up actions served as a tightening of monetary policy. Accordingly, they were associated with sharp increases in market interest rates and sharp reductions in the rate of home mortgage refinancing. So that's the past. Now I want to look forward. I now want to turn to the question of how I believe monetary stimulus should evolve over the course of the coming year so as to best achieve the FOMC's objectives. Now I'm going to focus on the particular issue of how the FOMC should adjust the target range for the Fed funds rate. And as has been true over the past 6 years, as you well know, that target range is currently set between 0 and 1/4 percentage point. And the main issue facing the committee that there's a lot of discussion about is, should that target range be raised soon? So I'm going to first answer this question using the reference policy rule that is contained in the FRAT Act that is under consideration by Congress. This is the act that I referenced at the beginning of the talk and the reference policy rule that I talked about at the beginning of the talk. And I'll explain why I believe that this answer may be misleading, that turning the reference policy rule may be misleading. I'll then turn to another approach that I view as more reliable. Okay, so the FRAT Act contains a description of a specific reference policy rule for the FOMC, and I've depicted that reference policy rule on this slide. The top part is reference to the left-hand side of the Taylor rule, talking about the Fed funds rate, and then the right-hand side is the various pieces of the Taylor rule, A, B, C, and D. The reference policy rule describes how the Fed should set its target for the Fed funds rate, given recent observations on inflation and real GDP. Note that the rule relies on an estimate of potential real GDP. So if you go to here, as is true in Taylor's rule, it makes a reference to an estimate of potential GDP. Now, I'm not going to get into how one goes about doing that. And there are different ways, of course, of estimating potential real GDP. And in fact, there's a lot of disagreement about economists about how to go about doing that. My own estimate is that real GDP is about 2% below potential real GDP. With this estimate of potential real GDP, the reference policy rule implies that the FOMC should set the target Fed funds rate equal to about 2%. That's about 200 basis points higher than its current level. In passing, I'll say that when I make that calculation, I'm leaving out the stimulus that's being provided by the Fed's balance sheet, all the long-term assets we're providing. If you take that stimulus into account, actually the Fed funds rate should be even higher than the 2% that I made reference to. But my point is, there are good reasons to be skeptical about this recommendation. So this is what you see written here is Clause 9D of Section 2C of the FRAT Act. And what I'm going to focus your attention on is Clause 9D, very bottom here, 2. It has that single word. This word refers to what macroeconomists call the natural real rate of interest. Essentially, the interest rate net of inflation that is expected to prevail in normal economic times. For many years before the financial crisis, the natural real rate of interest did seem to be in the vicinity of 2%. But I would say most macroeconomists agree that the natural real rate of interest is not fixed at 2 or anything else over time. If businesses are particularly uncertain about future tax policy, they'll all want to save rather than to invest in new projects. That extra demand for savings will push down on the natural real rate of interest. If households are particularly uncertain about their future incomes, they'll want to save rather than spend. Again, that extra demand for savings will push down on the natural real rate of interest. If banks are ordered by their regulators to hold large amounts of government bonds, that will push down on the natural real rate of interest. All of these forces go in the same direction, and they suggest that the natural rate of interest is lower now than in the past, and therefore lower than this number 2. And that means that monetary policy should be more accommodative than is applied by the reference policy rule. Now, I want to be clear. The proposed legislation allows for the FOMC to deviate from the reference policy rule. It's not saying that the committee has to follow this rule. But the legislation views deviations from the reference policy rule as being undesirable in the sense that it requires the FOMC to provide Congress with a detailed justification for any departure from the reference policy rule within 48 hours. My point of view that this perspective is misplaced. The reference policy rule does not allow for the possibility the natural real rate of interest varies over time. And as I've just discussed, the source of why we might well think that we've seen that kind of decline, that kind of variation, in fact, declines in the natural rate of interest in the past few years. Okay, so I've argued that the basing policy choices in the reference policy rule enshrined in the FRAT Act is likely to lead to undesirable outcomes. But how else should the FOMC decide on its appropriate policy choices? Now, to answer this question, I find it helpful to return to my earlier analogy of a corporate performance evaluation. So many employees in America are evaluated in terms of their performance with respect to pre-assigned goals. But they are given a great deal of latitude in terms of how to make choices that will achieve those objectives. The best employees are the ones that consistently use that flexibility to optimize their success with respect to achieving their pre-assigned goals. Now, the FOMC, as an employee of the public, also enjoys a great deal of latitude. But to be a good employee, we should be using that latitude to optimize our success with respect to achieving our macroeconomic goals. This goal-oriented approach to monetary policy would focus on keeping the economy as close as possible to the FOMC's objective for prices and employment. Basically, you're trying to achieve success with respect to the backward-looking evaluation that I did at the beginning of the talk. You should be making choices now so that when people come, when someone looks at your outcomes down the road, that you're trying to optimize success with respect to that backwards look later. Now, this kind of goal-oriented approach of trying to keep the economy as close as possible to the objectives for prices and employment has sharp implications for near-term monetary policy decisions. Now, my own current assessment is it will take a few years for inflation to return to 2% from its current low level. One reason I say that, although not the only reason, is the behavior of core inflation. I showed you earlier the blue line, which was PCE inflation. The red line is core inflation. It's also been running below 2%. This goes back to really the beginning of 2012, and we see that core inflation has been running below 2% over that time and is currently around 1.4%. Core is going to offer us a better forwards look in terms of what's going to happen to inflation because it's stripping away noisy food and energy prices. So my own assessment is that it's going to take a few years for inflation to return to its 2% level. And as I noted earlier, monetary policy affects prices with about a 2-year lag. Raising the target range for the Fed funds rate in 2015 would only further retard the pace of the slow recovery inflation. It would also increase the risk of a loss of credibility, in the sense that the public could increasingly perceive the FOMC as aiming at a lower inflation target. Hence, given my current outlook for inflation, I anticipate that if it were using a goal-oriented approach, the FOMC would not raise the Fed funds rate target this year. That's all on the inflation side, the price stability side. But deciding not to reduce stimulus in 2015 would also be consistent with a goal-oriented approach to the employment mandate. Increases in stimulus would push upward on employment. Such an increase in employment is entirely consistent with the pursuit of max employment that Congress has mandated for the FOMC. Now, admittedly, there has been considerable skepticism over the course of the past 5 years about the ability of monetary or fiscal policy to stimulate employment growth. I have, as Steve noted in his introduction, expressed some of those concerns myself on occasion. But look back to how rapidly employment growth actually did grow in 2014. The job market is finally on a highly desirable upward trajectory. We are more likely to continue on that welcome upward trajectory if the FOMC does not tighten monetary policy in 2015. So deciding not to, given my current outlook for inflation, deciding not to raise the target range for the Fed funds rate would be helpful in terms of both what's going on in the price stability mandate and on the employment mandate. Let me wrap up, and then I'll be happy to take your questions. The Federal Reserve has been given a lot of latitude by Congress. But that independence is to serve a purpose. It's to allow the Federal Reserve to achieve key macroeconomic objectives. We are ultimately accountable for our performance relative to those goals to the public and its representatives in Congress. And I have loosely modeled my remarks today on a standard corporate performance evaluation in order to facilitate that accountability. So more specifically, I've provided an assessment of the FOMC's performance relative to its macroeconomic objectives over the past 3 years. That assessment suggested that the committee did not provide sufficient accommodation during that time period. There are troubling signs that the credibility of the FOMC's inflation target may have fallen somewhat as a result. I discussed the possibility that the committee might raise the target range for the Fed funds rate in 2015, and I explained how, according to my current outlook, such an increase would only cause the FOMC to fall further short of its objectives. Thank you very much for listening, and I look forward to taking your questions.